my name is Jonathan Hall, and today we'll be talking about the construction of Founders Lane. And today I have Ben here to help me with some important information about the project. Would you like to introduce yourself, Ben?
I'm Ben, and this is the Founders Lane project.
Yeah, so firstly, Founders Lane is located in the central business district of Canberra in Braddon. It has the block size, has the total size of 25,630 metres, and once the construction is completed, the block will contain a 12-storey apartment complex with 700 homes over a span of 4 buildings. The construction was started in October 2017 and is scheduled to finish in 2020. So firstly, Ben, could you tell me a little bit more just about the project itself?
Yeah, sure. So Founders Lane was a project aimed to match in with its already established upper class stereotype and location of Braddon. And in this report, we're going to find out the financial factors of the construction and the evaluations of the project, and calculate building costs and forecast the flat cash flow during and after completion. And the data collected in this all comes from the All Homes website and sales and figures given from JW Land, the construction business.
Yeah. So would you like to explain how you obtained your data, just in a bit more brief, a bit more detail, and were they primary sources or were they secondary sources?
Yeah. So the primary sources were all the data listing, all the listings of the apartments by All Homes. These were used for the calculations because they were quantitative data as opposed to qualitative. The secondary sources used were from news articles such as the Canberra Times, which helped write the report aspect of the report as opposed to the calculations. With this data, it's also important to note that it's all averaged and it's all estimations and assumptions, so it's not entirely accurate, but it's the most accurate because there hasn't been any other research in Australia for this project apart from JW Land.
So from those data you've collected, what were you able to calculate?
So firstly, from that data, you can calculate the net present value, and this is just for stage 1 of Founders Lane. Once we calculated it, using an 8% discount rate over a 3-year return period, the NPV is positive $13.8 million. And this tells us that it's going to be positive, it's going to be profitable, and that it's an investment that we should take.
So Ben, from that figure that you've calculated in the NPV, what is the profitability index of the project? So
the profitability index over the 3-year period is 1.114, and this means that for every dollar that the Founders Lane project invests, it will get a return of $1.14. So therefore, it's going to be profitable for every dollar.
Okay, Ben. Let me ask you this: what if your clients say can't pay the total sum in that 3-year period due to say something financial reasons?
Good question. So it's over a 3-year period. That's a lot of stress to pay that back in one sum. So and if there wasn't enough cash inflows for that 3-year period, then the project itself would run out of money and go bust. So we've recalculated the net profit value again over a 10-year period, given the assumption that people are paying back their $516,000 apartment cost at 10% each year. So each year there's cash inflows of $51,600. In doing this, it provides a more accurate analysis of cash flows and how the project will go over a 10-year period. In doing this, the NPV is positive $14.7 million, and this makes it an acceptable figure for Founders Lane and a sustainable figure as well. And the difference between this NPV and the other NPV is $0.9 million.
Okay, so Ben, from that NPV you calculated over the 10-year period, were you able to calculate the profitability index of the project?
Yep, so because the NPV increased, so did the profitability index. So over a 10-year period, the profitability profitability index is 1.121, which means for every dollar spent, there's a profit of 0.120 cents.
Okay. So, and from there, are you able to calculate the internal rate of return for Founders Lane?
Yep, so the internal rate of return when initially calculated lay between 10% and 11%. And this figures means that if it was the internal rate of return was 11%, it would run at a loss, and anything before that would run at even more of a profit. So we were trying to find the point where it would pay itself off and be neither above or below the cost price. When doing this, we found out that 10.36% was the internal rate of return.
So the payback period for this project, could you mind explaining that for us?
Yep, so the payback period's outlined in Figure 6 of Appendix 1. It shows the payback period given that 10% of the apartments are paid again every year. And from the calculation seen there, the Founders Lane will become profitable between years 5 and 6 and will pay back off its construction costs. However, again, the payback period doesn't include the time value of money, so it's not as accurate or reliable as other methods of measuring. And it just means that the payback period will project a larger amount of money forecasted as opposed to the true amount of money, because money will depreciate over time and the payback period doesn't account for this.
Okay, so Ben, let's talk about the funding for the project here. So what were some of the prerequisites that JW Land had to have to first initially bid for the land, and what were some of their short-term fundings?
So before it bid for the land, JW Land had to prove that it had $40 million available credit, successfully developed and constructed 200 units, and also put down a down payment of 20% onto their final bid of the site. So for the $40 million credit, JW Land had recently bought out SHL Development, and that helped with its cash flow. Secondly, it also had built Campbell 5 precinct in Anzac Parade, and this successfully completed its 200 units. And then it paid a deposit of $4.7 million on their $447 million bid for the land, which was for Founders Lane.
Okay, and so another question, what were the long-term finances that Founders Lane required to complete construction?
So, upon having that $40 million credit, in this assignment we've assumed that $50 million of that has to stay in cash flow for the business. So in order to do this, it needs to borrow roughly about $10 million, and for this long-term finances, it can lightly leverage the Campbell 5 precinct. It does this so they can have more cash flows, but also have enough money now so they can invest into the later stages. So stages 1 can be being paid for and constructed, whilst also stages 2, 3 and 4 of the precinct are also being constructed at the same time, and yet they still have enough money to build it all. And the leverage is only of $10 million, which is a low leverage, so it's a safe investment which they can pay back at any time, because again they've got that $50 million cash flow. Yeah.
So cash flow forecasting is a pretty important part of a project. It enables businesses to identify and calculate future cash inflows and outflows of future periods of time. So could you please explain the cash flow forecasting for Founders Lane?
So the cash flow forecasting table is found in Figure 8 of Appendix 1. Here it outlines all the way the cash goes in and out of the Founders Lane project over that 10-year period at 4 different installments of payments, the first being 25%, 30%, 20% and 25%. So with all these factors in mind, we can calculate the total amount that was needed lending, and this amounts to $43 million. This is an important figure because it shows that the $50 million resting credit that JW Land has is able to pay back all of Founders Lane Stage 1 leveraged credit. So from this, we can establish that it's a safe investment, as well as the leverage, that they can pay back their leveraging and that they won't go bust. So the forecast for stage 1 is especially large, but because that includes the building as well as the payment for the land. The cash flow table allows a 3-month delay in construction. So over 3 years, it states that 30% is completed, and in the 4th year only 10% is completed, and this is to allow for weather delays and such and the expenses that go along with that in the construction. So this forecast is only designed for the 10-year period that it takes to pay back the construction costs. The forecast after this will look similar, however the inflow will reduce dramatically, and this is because the commercial space on the lower levels of Founders Lane will be bringing cash inflow, and the outflow will still be relatively consistent because of maintenance costs to keep the building running.
Could you please explain the variable and fixed costs of Founders Lane, and what effect do they have on the project overall?
So the variable and fixed costs for Founders Lane can be found in Figure 8 of Appendix 1, and this is where they break down the various inflows and outflows of the project. So just some examples are various taxes are for variable costs, miscellaneous outgoings, and utilities, which include electrical and gas and water. The fixed costs in this scenario are operational maintenance, such as like exterior cleaning, landscaping, any other needs for the building, property tax, insurance, and then of course the building costs.
Okay, so from those costs, what effect do they have on the project overall?
So it affects the project through the contribution margin per apartment, and for Founders Lane this is $2,100. So this means that this is the leftover amount of money that can go from sales that can go towards the fixed price after they cover variable costs. This breaks down into a contribution ratio of 30, which is quite reasonable for an apartment. And this further delves into the break-even points of sales. Founders Lane, this means that after 144 apartments, it will break even with these figures, and this can again further be explained through the break-even point of the sales revenue, and this is for Founders Lane just over $1 million.
Thank you, everyone. I hope everyone was able to gather a further understanding of the construction of Founders Lane. From the calculations seen in the report, we're able to see that the project will be acceptable and a profitable project for JW Land over the next few years. And thank you for listening. I'm Jonathan Hall, and this has been Ben.